in our mystery. A falling currency means an import-heavy nation suddenly faces massive domestic costs and ballooning deficits.
Section 3. Does the stock market matter? So who or what is responsible for this steep drop? To figure out what killed the rupee's value during this period, we need to bring our first suspect into the interrogation room, the booming Indian stock market. Lots of people assume that a country's currency and its stock market are locked in this synchronized dance. Now, what's really interesting here is the contrast. On one hand, we have our plunging rupee. On the other, the BSE Sensex index over the exact same period is showing wild growth, heavy crashes, and massive volatility. A fascinating research paper by Pankaj Sinha and Deepti Kohli at the University of Delhi investigated this exact relationship. They analyzed the Sensex, the IT sector, and the oil and gas index to see if the stock market was pulling the strings of the currency. Visually, you might totally be tempted to draw connections between the peaks and valleys.
So the crucial point is, the stock market was a complete red herring. The study ran the daily data through rigorous statistical models and found no significant interactions between the foreign exchange rate and stock returns. None. Literally zero. Whether it was the broader Sensex, the highly profitable IT sector, or the heavily imported oil and gas sector, stock market movements did not drive the exchange rate, and the exchange rate did not predictably drive the stock market between 2006 and 2012. We can officially cross the stock market off our suspect list.
Section 4. The true currency drivers.
If the stock market didn't drag the currency down, well, what did? It's time to unmask the true macroeconomic culprits, draining the purchasing power out of everyday wallets. Here's the actual rap sheet. The study identified highly significant variables driving the currency. First up, the inflation differential. When India experiences consistently higher inflation than the US, its purchasing power relative to the dollar just evaporates and the currency depreciates. Second, the current account deficit. In 2011 to 2012, India was importing huge amounts of oil and gold, pushing its deficit to 4.5% of GDP. Spending more foreign currency than you earn absolutely crushes your local currency. But finally, look at lending interest rates. This is actually a shield. Higher lending rates appreciate the currency by giving foreign investors a higher return on the country's assets, which draws capital back in.
But wait, there is one more massive piece to this puzzle: the growth of real GDP. When you track the erratic swings in economic growth, the study found a highly significant negative relationship between real GDP growth and the exchange rate. What does that actually mean? It means when the gears of the economy slow down, like when GDP growth dropped from near 9% to 7.5% or lower, it directly bled the currency's value. A shrinking economic growth rate acts like an anchor on the currency, just dragging it down against the dollar. So the real culprits are clear: high inflation, massive import deficits, and slowing GDP growth.
Section 5. Fixing a falling currency.
Now, a country's central bank doesn't just sit back and watch its currency bleed out. We enter the rehabilitation phase, where institutions step in to stop the freefall. Let's move on and see how this builds into actionable policy. By 2012, the Reserve Bank of India and the government had to pull aggressive administrative levers to save the rupee. First, they forced exporters to convert up to 50% of their foreign currency holdings into rupees, instantly creating this artificial demand for the local currency. Next, they increased the limit for overseas investment in government bonds up to $20 billion, basically opening the floodgates for foreign capital. Finally, the government cracked open the domestic market, allowing 51% foreign direct investment in multi-brand retail. These weren't subtle nudges, you guys. These were blunt instruments used to forcefully inject dollars into the economy, restore market sentiment, and artificially prop up the currency when macroeconomic forces were tearing it down.
Which brings us all the way back to your wallet and that laptop we talked about at the very beginning. Purchasing power isn't a static guarantee. It's honestly a remarkably fragile reality. Every time inflation spikes, every time a country imports more than it exports, and every time economic growth stutters, the invisible strings of the exchange rate pull at your local currency, quietly draining its value. So, as you look at the price tags around you today, ask yourself, knowing the volatile macroeconomic forces constantly at play, what is your money truly worth right now? Thanks for joining me on this explainer, and keep questioning the numbers.